Fed's FOMC latest minutes. China, North Korea, oh yeah, and then Trump. Should investors be surprised? Our answer and what it all means on this episode of the Cocktail Investing Podcast.
Welcome back, listeners new and old. This is the Cocktail Investing Podcast, where we look to distill everyday noise into clear investing signals. And if you've been paying attention to the headlines, especially this week, man, oh man, is there a lot of noise going on. But we're here again to make some sense of it for you, to help you figure out how to invest and what to think about it and what it all means. I'm Chris Versace, Tematica Research's Chief Investment Officer, and joining me, as always, is
Lenore Hawkins, Chief Macro Strategist.
Hawkins, were you just asleep at the switch there for a second?
Well, oftentimes you like to introduce yourself with my title, so I was just seeing if you were going to go with that.
You were waiting for me to make a mistake, is what you're saying.
I was waiting, for the entertainment.
The guffaw. I get it. But it didn't happen. I passed the test, and here we are, getting ready to talk to listeners once again about what's going on in the news around us. And I have to say, this follows a very special podcast we did last week where we talked all about ETFs and what to expect with Yasmin Day of JP Morgan, which was a great conversation, I have to say. So if you haven't listened to that, go back into the archives and listen. What you're going to hear is, I think, really going to set the stage for products and things like that and other developments that you'll be seeing in the ETF industry over the next, probably, I would say, 1 to 3, if not 1 to 5 years. So great conversation. And with that, let me just segue, Lenore, right into the other housekeeping items, and then we'll tackle the big questions like we teased in the opener. What's going on with the Fed's latest minutes, and what investors should be thinking when it comes to, and I would love to do this in the manner of Billy Joel's "We Didn't Start the Fire," but I just don't think I can go China, North Korea, and Trump. I'm not sure I could pull it off. Maybe you can.
I don't think anyone wants to hear that.
Yeah, I don't think so either. So, but anyway,
I actually would like to hear it, but I don't think anyone else does.
Yeah. We'll work on that off air. Anyway, so just quick housekeeping items. Please be sure to head over to tematicaresearch.com. You can see all our wares, as I like to say. You can check out Lenore's weekly wrap that comes out on Friday. Sign up for that. Great insight on what happened in the full week and prepares you for what is going to come about. We've also got a lot of thematic signals up there, which is our confirming data points that we see in and around the news and other media, surveys, reports that give credence and confidence to our thematic lens. We've also got past episodes of the podcast and, of course, our premium products. So check it all out. Again, tematicaresearch.com. Now, Lenore, it has been quite the week, I have to say. We're taping this on Thursday, May 24th. And we've had a plethora of retail earnings. We've got some economic data. But I think the two things that investors are focusing in on, and rightly so, are the latest developments regarding trade between Washington / Donald Trump and China and North Korea, and what we heard in the Fed's minutes and what that could mean for other interest rates in the back half of the year, as well as what it could mean for consumers in the economy.
Yeah, exactly. There's a lot of really interesting things came out of the Fed's minutes that were released earlier this week. And I think part of what was really interesting in those minutes was actually some of the things that was not in them. This release was surprisingly dovish compared to prior ones. And what that means, the dovish versus hawkish, for people who don't know, dovish.
Dovish versus Hawkins-ish? Was that what I heard?
Yeah. The dovish is that when you hear they're talking about the Fed being more dovish, what that refers to is that the Fed leaning more towards being supportive of the economy, which means lower interest rates, right? Looser monetary policy. When they're hawkish, they're thinking they need to tighten because they're concerned with inflation.
Okay. So what, Chief Macro Economist, what caught your eye in that report?
Well, okay, so this assessment, as far as their outlook on the economy, really, they were almost bizarrely careful to not change anything in their descriptions of the economy relative to the release after the May meeting. So that's interesting that there's, we had a month passed, but no change. they emphasize that while input costs and wages are rising, businesses are having mixed success passing on price hikes. Now that means that there's kind of a more muted effect on inflation. They did signal, unsurprisingly, that very likely to hike in June. Everybody expected.
Well, I expected. I think the Fed futures have priced it in at call me crazy, but 100%.
Yeah, exactly.
It is a foregone conclusion that they're going to do that.
What was interesting, there was a little bit of shift, was they signaled that they wouldn't feel the need to hike if the core PCE, which is their preferred method for measuring inflation, because there's a lot, inflation is a word that gets battered around a whole lot, and it's just, what exactly does that mean, and how do you measure it? That's the way they like to look at it. If that actually rose above 2% target, modestly over the balance of the year, so that's kind of interesting. They're really putting it out there that, well, before they've been talking about being concerned that it was going to get overheated and then they needed to get ahead of it. And this was more like, it's fine. We've been below for so long that if we go above, that's okay.
Do you think, well, a couple things. One, they have, clearly been on the wrong side of the inflation data for a long time now. Right?
Oh my God, for how long have we been hearing that inflation is right around the corner?
Yeah.
Right around the corner.
What's the word there? Transitory, I think, is the word that they use.
My God. Like the single most resilient effects have been those transitory effects.
Right, exactly.
Never go away.
Exactly. And what I'm hearing from you and the comments that you recanted from what the Fed had to say is, it sounds like that businesses are seeing price increases, so we should see some pickup in maybe PPI. That's what that sounds like. But they're not having. We are seeing that. And we're seeing particularly, which is not a surprise when you look at what's going on with oil. No,
right?
But
energy prices.
Well, it's transportation costs, yes, which you wrote about, which you recapped very well in last week's weekly wrap. But it's also protein inputs, it's wages. We're hearing that from a number of companies, particularly those in your home state of California. Steel costs, other commodity costs. So we are seeing that, but it's
Let's not forget the tariffs.
Well, what tariffs? The tariffs that are on, the tariffs that are off. Those tariffs.
Exactly. That's a very good point.
So, but let's talk more about that when we finish talking about the Fed. So. But the point I'm making is that we might start to pick up in PPI. We haven't really seen it as much in the CPI. That's what we'd be seeing in the data. But I think if we look year over year in the PCE, I seem to recall the last month or two was above that 2% level. And I'm wondering if the Fed is saying something along the lines of, we see it picking up, it's not going to be a problem, because they don't want investors to freak out and go, hey, we're thinking 3 to 4. If this data keeps up, could we have more rate hikes than that?
Well, here's what's really interesting. Talk about this time it really is different. So here we are, 107 months into the expansion. So keep hearing us talk about that second longest expansion in history. We've got unemployment. If we want to talk about the labor market, unemployment, which you and I aren't so excited about the unemployment rate, but nevertheless, that is something that the Fed refers to. And the unemployment rate is at levels not seen since, I think it's 1969.
Yeah.
So, right. So according to many standard metrics, the economy should theoretically be doing really well, right? We should theoretically have a really tight labor market. Now, we're not seeing the wage pressures you would expect with a unemployment rate that we haven't seen since 1969. But there's a whole bunch of other reasons for that. What I found really different, that this is really a different situation with the Fed, and the economy is very different this time around, is that the Fed in these minutes acknowledged that monetary policy still remains highly accommodative. Now that's actually, to me, that's, given where we are, that's almost kind of a disturbing remark, because there's no indications, not a whole lot of indications, that there's a ton of slack, according to the Fed's metrics, that there's a ton of slack in the economy. We're 107 months in, second longest expansion in history. Unemployment rate down that low, and yet we still have this highly accommodative, and the Fed's saying, yes, they are accommodative. They expect that, and they expect that that'll stay that way. They're not planning to be highly unaccommodative in the next couple of months.
So I hear you saying that, and I'm as someone who got started looking at industrials and thinking of capacity utilization and slack in the economy around certain levels. I'm having a tough time with what you're saying, and I think perhaps a different way to say it, correct me if I'm wrong here, is that we have all these indicators that appear to be positive for the economy. But what would happen if we really took the training wheels off?
Oh, exactly. Well, that's the whole point, is that here we are at this point, the economy should be in a very different state than it is.
Correct.
And you're thinking about like capacity easy for me to say, capacity utilization rates.
Right.
It's an early morning for me. And that those are low, but the capacity utilization rates have actually been, I mean, yes, they are still low, but they've been trending lower for like decades because we've shifted away from being this highly industrialized economy into one that is more tech focused.
Absolutely. Yeah. No, I'm aware of the structural implications. I'm just thinking, you tend to think when you hear the word slack, it means there's excess capacity. And I don't know that there is excess capacity in the economy. I think there is by certain metrics, but I think when we talk about the pace of the economy, the speed of the economy, the vibrancy of the economy,
which is just not there.
Which is why the Fed continues to remain somewhat accommodative, and as you said, probably will be for a little while.
But that's measuring more how fast we're going versus how much of the resources that we have are they being used. When you have job openings, the difference between job openings and hirings remains at
huge.
Record levels, right? Yeah. So we have all these job openings, and yet you can't find anyone to fill those jobs, right? That's most businesses' number one problem, that they cannot fill the jobs that they have available. That indicates that there's not a whole lot of slack. Like slack as far as the employment market would be, you have a lot of people sitting on the sidelines, there just aren't jobs available. And as soon as a job gets out there, boom, they're getting grabbed. Right now, you just have people who are looking to be in the workforce, but don't have the skill sets that companies are looking for, right? So if we want to call that slack, it's a little bit different. But what I just find it very, it fits with what we see going on in the economy, but the reality of the economy is this time around, things are really, really different. The structure is very different. And a big part of that is one of our investing themes, the boomers.
Yeah, the boomer economy, or as we used to call it, aging of the population.
Yeah, the boomer economy, we built, you see that rampant inflation that happened in the 70s. And then, a little over into the 80s, that was caused because those boomers, this massive group, came into the workforce, were making a bunch of money. Because there were so many of them. Then they wanted to buy clothes, they wanted to buy cars, they wanted to, buying all this stuff up. And so we had to the capacity
scale
for the
up.
economy, it was well below what they wanted. So you had all these prices going up because you had this big, the pig and the python. They came in and they wanted to, they were going into those peak spending years. So the economy had to ramp up its capacity to fulfill that demand. Well, now as they're heading into the retiring years, the demand goes down, right? When you buy a lot.
They're now, to your point, they're no longer spending the way they used to. Not quite like drunken sailors. But as they move past 65 and increasingly towards 70, they're on fixed incomes, which means that they're more in conserve and preserve.
Yeah, and they I think a couple interesting things about them. Not only were they a massive generation, right? So that alone was going to do it. But this was also the first generation. You think about the generation before them. The generation before them had a deathly fear of debt because that generation had gone through the depths of the Depression, right? So these were people who did not like any debt. The boomers were raised by these guys, but the boomers, they come in and they're like, yeah, that's fine. So during the boomers, not only was it a huge group that pushed demand, but then they leveraged their demand up by going crazy with debt, right? So it was it almost exacerbate the demand that they had. So the economy had to develop all this capacity for this enormous group. Now, your spending habits when you're 35 are very different from your spending habits when you're 75.
Oh,
when you're,
trust me.
right?
I just spent some time with my 86-year-old dad. I can tell you things are different.
Yeah, so I mean, think about the boomer generation. It was the largest generation the world had ever seen across many countries. They were the wealthiest generation the world had ever seen. They bid up demands for goods and created incredibly rising prices in the 80s. Then, unlike their parents, they preferred to spend over saving. That meant that the capacity for the economy had to be that much bigger. And now we're left with this capacity for a generation that, the X generation is tiny in comparison. And there's already all this debt in the economy, right? So demand just has to start ticking down. And then you look at the millennials, and the millennials just don't have the same kind of spending interests. And the millennials are saddled with record levels of student debt, right? So structurally, the economy is very, very different than in decades past.
So bring me all the way around. Is your thinking then that the Fed, this is the reason why the Fed is going to remain modestly accommodative as long as it can?
I think the Fed doesn't want to see the economy collapse. And when you have the biggest driver of demand, those boomers, looking to consume less and less and less and less, it's going to hurt. So I think one of the things that they're doing, and why this cycle has been so different, is this is the cycle where the boomers are really moving into retirement. So that you've got a massive shift in the demand, not only in our economy, but in Europe's economy. Much of the developed world, China as well. China had a very large boom population. China's going to get one of the only countries in the world that's going to get old before they get rich.
Yes.
Right. So you've got the demand curve all over the world is shifting down. And I think the Fed's trying to kind of soften the blow of that.
So does this tell you that interest rates are likely to peak lower than they have in previous rate hiking cycles?
Much lower, yeah. I don't think the Fed's going to get anywhere near where we have in prior cycles. I think they're still probably going to be what tips us over into a recession. Meaning
the Fed and rate hikes tipping us over.
Yeah, the Fed, the rate hikes, because we've got the yield curve, and that's the difference between long-term rates and short-term rates. That difference keeps narrowing, not on a constant basis, right? It's just like the market kind of wobbles around, but over time we're seeing those shrinking, and demand isn't. What is the thing out there? And this is what. The other thing that's going to be, I think, very different this time around, we've never kicked off such significant fiscal stimulus at this point in the cycle.
Right.
Right towards the very end, we're using that fiscal stimulus. Normally that fiscal stimulus is kicked in when you're in the recession or maybe just coming out of a recession and you really need to
kickstart the economy.
Exactly. Right now, we're just trying to keep the party going.
Exactly. I think they're trying to extend the recovery as long as they possibly can, whether it makes it to, I think the longest one is 140 something months, right?
Yeah.
We will see if we get that far. Okay. But it does seem that the Fed has signaled that they will increase in June. And I think the market is pricing in, I think it's 94% for a September rate hike. And we're starting to see
chances of a third, so we could get a total of 4 this year.
Well, we could get a fourth, and I was talking with Bob Lang yesterday, who I do some stuff with over at the Street, that they're already starting to see probabilities come up for a 5th rate hike this year. Oof. Which is kind of fascinating. And I say that because you and I, we track a lot of data as it relates to our investment themes. And in particular, rise and fall of the middle class, or quote unquote mixed squeeze, as we're internally calling it these days, as well as the cash-strapped consumer. And we've been trading, different data points, stuff from Lending Tree that's talking about how consumer debt is now taking up 26% of disposable income, up from 22% during the Great Recession.
So we've got, but that to me, that's a huge statistic.
Oh,
we've got consumer debt as a percent of disposable income is today worse than it was when people were in the depths of despair during the Great Recession. That's eye
popping. I totally agree with you. At the same time too, and there's more. right? There's more data. 40% of Americans could not stomach a $400 emergency payment.
And when you think about where we are in the cycle, right, this is where people should be fairly flush.
Yes,
right?
yes.
You should be flush at this point, because the way the business cycle works is you go through a recession, everyone gets hurt, right? Spending is put on hold. You shift into saving, and everybody just kind of hunkers down, right?
Right.
Then things start to get better. People start to spend. Income starts to go up. Spending goes up. You get this positive spiral. As you get to this phase, people should be they need to have that, like, preparing for winter. Right? The squirrel has got to have some nuts in that nest.
It always somehow it always comes back to sweaters and bathing suits, doesn't it? It always comes back to that.
It's winter. Those squirrels need nuts in their nest, and we don't have much. So when you think about what does that mean for the next, because we're going to have a recession, right? They happen. You cannot policy away a recession. You not only do you have where a good chunk of the population doesn't have enough to cover, was it $400? 40% doesn't have enough to cover $400. Okay, what does that mean when we go into a recession and those people lose their jobs, right? On top of that, you have, and this is going to be really interesting to watch what happens with the market. You have the baby boomers, right? The largest generation in the country, either in or moving into retirement. And they have much, much, much more risk than would be typical. They've taken on much more risk because for two reasons. One, as a generation, they didn't save enough.
Right.
Two, they liked spending over saving, so they didn't save enough for retirement. Two, they got slammed during the Great Recession.
Right. And
right? They lost so much. And then three, these artificially low rates have been forcing it, which is the intent of artificially low rates, to push everyone out. So you've got people who don't have enough in savings, and you have all these people either in or moving into retirement who don't have really enough to get them through retirement and are way out there on the risk curve.
Absolutely.
What happens when we get that recession, and that recession by definition causes not by definition, but most likely pushes the market down significantly.
The only thing I think you left out, just to touch on something you mentioned earlier, is that generation is much more comfortable taking on debt. And go back to that, lending tree comment that we had about 26% disposable income and others. We're even seeing delinquency rates on small bank credit cards shoot the moon.
Rising.
Right. So we're seeing that. And those delinquencies, I think, are as of 30 days past due. So that's a problem. We're starting to see delinquencies pop up again for auto loans. So it's at the margin, it's a little concerning. But what bothers me is this is something that Lending Club, ticker symbol LC, said last week when they reported their earnings, that they are already seeing credit card rates tick higher by 75 basis points year over year. And that's before we've seen really what's to come on the interest rate hike front, which tells me.
Right. You think about all those people who are already default or already delinquent, and you think about all the balances that they have, and those balances are just going to get that much more expensive.
There's that. Or to flip it around, that 26% of disposable income going to consumer debt service is going to go higher. At a time when consumers are grappling with other inflationary forces like we were talking about, whether it's gas at the pump or other if companies are successful passing other price increases through, it means their overall piece of disposable income is going to shrink. And I think it's I don't want to be Debbie Downer here, but it says to me that I'm going to try and put a sunny face on this. Hey, that cash-strapped consumer theme, a lot of pronounced tailwinds coming.
Yeah, definitely. That is an area, a growth area, oddly enough.
Right. But I also think that when we flip it around, it's another reason to think what you were saying earlier about the economy. The Fed almost has to remain somewhat accommodative, because what happens if they take the wheels off and they go even higher? Things get, what I mean?
We already see that going with what's going on in the housing market. I mean, the housing market has definitely rolled over.
But the amazing thing is the prices continue to tick higher.
but the volume is tiny.
Oh, no. I understand that. I understand that.
And it's just getting more and more
But it's
unaffordable.
Well, A, it's more unaffordable, and B, I think the prices will continue to tick higher because lumber prices continue to move higher.
Yeah. Well, Tara, there you go. Mentioning that T word.
There you go. There you go. All right. Well, so, I think what we're coming around to is something that we've been talking about internally for quite some time, which is as the Fed, continues to rake hikes, it's going to get that much more expensive for consumers, particularly cash-strapped consumers, to service the debt that they do have, even as they're taking on more debt while they can. Because let's be honest, there's another statistic, and I'm blanking on it, but it's something like 4 in 10 Americans are living paycheck to paycheck.
Well, and that's just the consumer side. What about the corporate side?
Look, there is massive amounts of debts that have been floated over the last several years to fund buybacks, dividend increases, and other general corporate purposes. That when they get refied, it is going to hurt. It's going to hurt. But I do think though that these lower tax rates will help shield that to some extent over the next 5 or 6 years. So I'm not as concerned about that in the near term, but longer term, absolutely. When you see the impact of that refinancing hit the bottom line, no doubt about it.
Excellent point.
I try. So we are still concerned about the consumer and its impact on the speed of the economy. 2/3 of the economy is consumer driven, directly, indirectly. So that's something that we'll continue to watch. But talk to me, Lenore, because I know you were on Fox Business a couple days ago talking about trade. Obviously, I think just to recap, about a week ago, it was looking like things might have been gotten a little better. China was actually giving some concessions on auto imports and auto parts. And
that was, and we have to put that in context.
Yeah.
Yes, they were giving concessions to the U.S., but they'd already given those concessions to Europe. So they were kind of getting credit for something that they were basically going to do anyways.
Well, that's what makes unfortunately, that is what makes headlines.
Exactly.
But that is a valid point that it was probably going to happen. And let me just put that to the side for a second and come back to that. So what we have seen since then is there was some concern. I think President Trump tweeted something to the effect of, "I have no idea if we'll have a meeting with North Korea or not." And then he was kind of finger wagging at China a little bit over not being continuing to be tough on North Korea.
And then just this morning he announced it's off. So Thursday morning, he said, "Nope, not meeting."
But that follows. But remember too, that follows Wednesday, where Trump said, "I think we're going to have some our own automotive import tariffs, right?
Yeah.
For quote national security concerns."
Right, well, it's kind of like the lumber and steel that are national security.
Right. So I guess what I was thinking is that it several months back, we talked about Trump kind of following Art of the Deal, his book.
Mm-hmm.
Keep your enemies off balance as you negotiate this, that, the other thing. And I'm just thinking that, has that really changed? Should we be surprised by any of this?
Well, I think the first year of the administration was very much the honeymoon year, right? Where it was completely adorable how he finished my sentence. And I thought it was really cute that I kept finding his socks around the house. And now we're into the second year of the marriage where it's just damn annoying that he keeps interrupting me. And can you not put your clothes in the hamper?
Why is the milk
and the market?
Why is the milk on the door, not in the refrigerator?
Exactly. I think the market is starting to realize that it's not all sunshine and roses, because the first year was this is all fantastic, and right now that Art of the Deal style ends up being complicated, right? Because it makes more instability, because the market was like, oh, this is the best, look at his negotiating style is fantastic. He's brought China to its knees. He's brought North Korea to the table, and they're all gonna.
But there's a problem with that. The problem is that everybody knows he wrote, everybody knows he wrote this book. People have started to figure out he's playing this game.
Yeah. Yeah.
And what happens then is it's I said this with Matt Ray on America's First News this morning. It's like Bugs Bunny and Yosemite Sam, right? You cross this line, you die. No, you cross this line, you die.
This line.
Yeah. So what happens is, it starts to get the back and forth escalates. It ratchets higher and higher. That I don't think the market has the stomach for that.
Well, I think too we're seeing we're actually starting to see some more internal pushback. And I think the administration is finding the kind of the parameters around what it can and can't do. And for example, here what I'm referring to is earlier this week, the Senate Banking Committee voted, I think it was like 23-2, to limit what the administration could do with respect to these fines, and I'm talking about ZTE, right? Because Trump came up last week, and over the weekend he was talking about how China had come to him and said, like, you got to work with us on ZTE, because ZTE was this company that sold against the rules, basically against our rules. They sold technology to North Korea and Iran, and that made phones that had ZTE technology in them, telecom that had ZTE technology in it, could be used for espionage. And even the CIA director came out and said, Christopher Wray came out and said he was very concerned. He wouldn't specify any particular company, but he said he was very concerned dealing with these companies that are basically owned by foreign governments. And they're owned by foreign governments that don't share our values, our concern.
He was saying naming them without naming them is what you're saying.
Exactly, without naming them, and saying that what it could result in is us having within our telecom system undetected espionage. The potential for undetected espionage. So then the Senate Banking Committee comes out and votes to really curtail the administration's power on these. And then Trump kind of turns around and says, no, there's no deal on ZTE. And I think he ran into a wall, because it gave the appearance, and I have no idea what was going on in those conversations, so I'm not making any judgment on it. But from the outside, it looked like it was easy for his opponents to make the case that he was negotiating with national security for trade deals.
I think you might be right on that. I also think, though, too, that let's remember we have the midterms coming up. And I think that given Trump's approval rating, the people who are running are going to do whatever they can to kind of shore up their position to help improve their own reelection odds.
Right. So that I think that we're starting to see things get complicated, right? And China. And I'm still surprised, though, that anyone in the market thought that this was going to go easy. I mean, China has long been. China.
Oh, hang on. You said something. I know where you're going, but I just want to help you with this, because you said
Remember
something.
That whole comment about the interrupting?
Yeah, I know. But I want to help you here. You said something so well the other day on Fox Business, where you're talking about the long road and a lot of disruptions along the way. I think you were on with After the Bell with Melissa Francis and David Assman. And you were talking about how, there's going to be a lot of stops along the road negotiating with China, but China is not necessarily going to go, oh, yes, America, you are absolutely right. Yes. And roll over. It's going to be a very long road.
A very long road. I mean, China is a very proud nation, and understandably so, given that they have been 2,000 years, roughly, one of the strongest economies in the world. You put China and India together, and they accounted for 50% of world GDP for most of the past 2,000 years, with the exception of when the Industrial Revolution kicked off, and then you had the economic power shifted to the West, and now it's shifting back because they just have more people.
So, you're saying over 2,000 years compared to that little upstart country, America, that was around for about 242?
Yeah, exactly. I mean, from our perspective, we still feel like we're the biggest guy on the block, and we are for the time being. But China's not culturally. The Chinese leadership is not going to be able to roll over to us, and I think that makes this negotiation even more difficult, because we have a president who definitely his style is more, say, pushy. I'm going to get my way. This is what I want, and you're going to bow to me. You're going to bow to my will. And he's going up against a country where culturally the leadership is not going to be able to give the appearance that has actually happened. As
someone who grew up in New York, right, I can say this. You can take the man out of Queens, but you can't take the Queens out of the man. Yeah. That is what you're talking about.
And we have a similar thing with North Korea, right? Like he's not going to want to give the world the impression that he bowed to Trump, and Trump wants to give the impression that he has won.
So,
right? Because he looks at trade negotiation as there's a winner and there's a loser, and he wants to make sure that everyone sees him as the winner. And that dynamic just makes this all the more complicated.
So from your perspective, this is going to be a long road. There's going to be a lot of, fits and starts. Right. There's going to be a lot of headlines, a lot of showmanship. How long does it take till we actually get a deal, if we get a deal?
Oh, it's going to be years, I would say. I mean, but that's the challenge. But on the other side, you've got China needs us and we need China.
Right.
These are two titans, two economic titans. We need their markets to sell stuff to. We like getting stuff cheap from them.
That made Walmart, didn't it?
Right? So we need them. They need us.
Mm-hmm.
We're a huge market.
So is the message that we should not expect easy conversations? They'll continue to be contentious, like we saw over the last week.
And it's going to be little steps. We're not going to get big sweeping changes.
So from an investor's perspective, recognizing what you're saying, it simply means that I, as the investor, need to understand this and just be comfortable with some uncertainty from time to time and picked up volatility from time to time.
Yes, and those headlines that China's come to the table and China's going to bow to our will. It's not exactly what they say, but the implication of that, you need to ignore those headlines.
Right. Well, I think that's. I would close out by saying that the smart thing to do is to be a prepared investor. We always say have your shopping list prepared.
Yep, exactly.
We do that with the Tematica investing select list as well as the contender list. Continue to follow thematic signals. Again, that's signals that are derived by the changing landscapes of the economy, demographics, psychographics, technology, and some other things. They've served us rather well, Lenore, and I think that they will continue to do so even amid the tweet storms and over-the-top headlines.
Yep.
All right, I'm glad you agree. I'm glad you agree with that. All right, so we'll leave this podcast here, and we'll be back next week with more. But be sure to circle back, because later in the week, Lenore, you'll have your weekly wrap, and we will have much more thematic signals, all on TematicaResearch.com.